Hello and welcome back to TalkingCREF, the California MBA series where we feature one-on-one conversations with our members about hot topics in the commercial real estate finance space. Today, I'm delighted to chat with Rex Evans of Derivative Logic, who has been a longtime supporter of the California MBA. But before we get into it with Rex, please check out our website at thecmba.com for more info on our voice, our causes, and our membership. Rex Evans, welcome, sir.
Thank you, Cody. Appreciate the invite. Talk about our firm and any questions that you pose. A little bit about Derivative Logic. I founded an independent advisory firm back in 2006, and not so much because of the transparency with regards to derivatives. I was on the other side, on the banking side, but it's more than that. It's really about education. Transparency, sure, I could screen and we get a price, but what type of hedge is important? And what's best for you as the borrower on mitigating interest rate risk. So we're all about education. We say 99% education, 1% transaction. And our group comprises those who have worked on a capital markets desk. So we have the experience and have gone through many a cycle.
Very good. Well, thanks for that, Rex. So Rex, a couple weeks back, you and I were recently chatting about the business, and you had mentioned a few recent deals that you had worked on. You had shared that the borrower in those deals was working through a bridge loan with a floating rate component that needed an interest rate cap and for the lender. And so when you take a deal in like that, I would like to understand, for the benefit of our other members, particularly the mortgage bankers like me, to understand a little bit under the hood about your approach to solving, what a premium looks like on a particular cap or what strike is best for the client. So as a start, though, can you give us a primer on how cap works and where that premium really factors in?
Think of a cap as like an insurance policy. You pay for it, and you own it. And it's set the level of the strike, let's say against LIBOR. LIBOR is currently traded at 0.110. Where is your pain threshold? Like how much you gotta, all right, I'm hurting now if LIBOR goes above a certain level. And that's called a strike on the cap. So LIBOR cap struck at 2%, you're floating, and once you breach that 2%, you'll get paid by whoever sold you that cap. And so you're just floating here. So as far as the strike goes, again, it's that pain threshold we look for. But oftentimes on a bridge loan, it's the lender who determines the strike. At what level is the borrower in trouble if LIBOR breaches 2% or 2.5%? So they're the ones that often dictate where the strike level should be. There are times when situations where that strike can be adjusted higher to lower the premium down. And we can work with borrower and lender and see if we can accommodate a different strike, a cheaper strike, by doing what's called a step up. Start at 2% the first year, 2.5%, and then 3%. Which would substantially bring down the cost. One thing the way you think about a cap is a series of caplets. So there's a cap for every single month going out 36 months. Now your first caplet, let's say in June, for the June accrual period, LIBOR is expected to set at 0.11357. Well, if you got a 2% cap, that little caplet probably can't buy you a Frappuccino venti. So by adding up the value of all those caps for 36 months, that's where you come up with the premium or the cost for that cap. So the latter months are the most expensive. The most important component, though, of pricing a cap is volatility. If rates are doing nothing, just kind of cruising along, and then all of a sudden, going up and down, that creates that increases the cost of the premium. Whether interest rates have fallen, volatility could go up and the cost of that cap goes up. And it's kind of like the borrower said, hey, you quoted 40,000 yesterday and today it's 45 and interest rates have gone down. Well, that's volatility. Or that's how much volatility can impact the cost of a cap.
So a borrower or a mortgage banker is thinking about using derivative logic. They're thinking about saving money, right? They're thinking about lowering their premiums or whatever control we have. And they're thinking about in the context maybe of using your services versus another firm that does, similar cap type structuring. So what factors help drive that decision?
It's really our transaction cost or our advisory fee. And it's not where we can get the best premium or cost. All the good advisors out there get exactly the same price that we do. We run hundreds and hundreds of millions of dollars through the dealing banks. So it should not drive the client's decision to work with us. We price in range, let's say we got a quote at 20,000 or to 22, 23, but those are indicative price. Knowing real estate, right? It's not a price until it's sold as far as a dealing price level goes. So it all comes down to experience, value add. We don't like surprises, and you certainly don't like surprises. You don't want to tell your client one day, hey, that cap costs 50,000, and then 2 weeks from now, 75,000. You need an explanation. So what we do is, if I can lean back here, is we put together a spreadsheet with all the indices. We timestamp it. We provide a range, and then what LIBOR is expected to do. So a couple weeks down the line, if you want to refresh, we open up another tab, and you can see why that cap cost has gone down or has gone up. So value add, coming up with ideas like step up caps, working with the lenders, maybe make that cap a little less expensive, 2-year versus 3-year maybe. Also, a lot of loan agreements call for credit. Well, they all have to have credit ratings that are acceptable to the lender. And some are set too high, which I would call like out of market. So we'll work with lenders, hey, we need to lower your credit, your credit criteria.
So it sounds like, as a mortgage banker or broker, or as a borrower, a lot of these factors really are going to inform their decision-making process as they get closer to that closing date. How can they best get in contact with you?
Go to our website, check out what we do. We are involved. We also do defeasance and swap or just regular derivative advisory, not the required cap, foreign exchange as well. But what we do best is to teach, and we do derivative 101 classes. I think that borrowers tend to just focus on one aspect of mitigating risk. Like, oh, I always fix my interest rates. Well, sometimes that actually adds risk, because if your business model is, get 10-year money, but I want to sell the property in 5, why are you fixing 10 for 10 years? You're actually adding risk. And so we look at it, we take a macro view on a borrower's portfolio, because they may have CMBS, they'll have agency, bank loans, bridge financing, and kind of give an overall perspective on the entire loan portfolio. And that's where we really add a lot of value as a firm.
Well, very good, Rex. I appreciate your time. And as he said, check out his website and all the very resources that they put out there to help guide these decisions. Appreciate it. And thanks for joining me today.
Thank you, Cody.
So as I said, check us out on the CMBA.com. Find out more about our awesome members like Rex. And until then, this is TalkingCREF, Cody Charfauros at Slatt Capital signing off. Thank you.